Welcome to the Real Estate Syndication Show. Whether you are a seasoned investor or building a new real estate business, this is the show for you. Whitney Sewell talks to top experts in the business. Our goal is to help you master real estate syndication. And now your host, Whitney Sewell.
This is your daily real estate syndication show. I am your host, Whitney Sewell. Today, our guest is Josh Eitingon. Thanks for being on the show, Josh.
Thanks for having me. Excited to be here, Whitney.
Yeah, Josh is the founder and manager of JAE Property Group. Through JAE, he and partners have transacted over $20 million worth of multifamily assets. He's active Chamber of Commerce member and honoree and from Long Island, New York. Josh, why don't you give us a little more about your background and how you got into the syndication business?
Sure. So I always wanted to get into it. I started, I think, the way a lot of people started, just reading. I read a lot of Rich Dad, Poor Dad and a number of other books along those lines. Out of college, I worked for 5 years for a software company, knew I wanted to get into real estate somehow. And through a winding path, I was connected with a property manager, and myself and one other, we partnered on our first deal. That was a syndicated deal, a 20-unit distressed property in a pretty rough around the edges part of Cincinnati, Ohio. We bought 20 units distressed for $175,000. It needed about $200,000 worth of work, and that was my jump in. So that's how I started. I was 25 when I did my first real estate investment, and since then I've been growing in deal size and scale. Ultimately leaving my last job about last year to really pursue JAE full-time.
So why syndication? Why not house flipping or, some other type of real estate?
So I'm always drawn to multifamily. The thought process of one vacancy for 20 units being 5% vacancy versus one vacancy on a single family being 100% vacancy. I just felt like there was safety there, in its simplest form. And the syndication side was partially primarily out of necessity. At the time, especially my first deal, maybe I had $60,000 to my name. And that was only going to take me so far. That was my only option to sort of facilitate the strategy that I wanted to follow.
So you were working another job. You knew you wanted to get into real estate. You started reading. You started educating yourself, and then you found team members, right? You said you found the property management company or a property manager that you were going to partner with, and so how did you all find the 20-unit deal?
So that was identified by a property manager. I was connected to him and just staying in touch with him and really on top of him in terms of trying to help me find a deal. He was a property manager that also had a brokerage arm. Frankly, they did a lot of that, trying to manufacture opportunities, put it in front of different clients and know that they would get the management side of it. So that was one deal he did a really good job, get it going directly to a bank. That identified this distressed deal, and we paid him a wholesaler fee as part of that, on top of giving him the management after the fact.
So had you invested in real estate or purchased other rentals before this 20-unit?
Never.
Wow. So your first deal was a 20-unit syndicated property. So tell me, how did where did you get the confidence to go into a syndication, the very first deal? I hear it all the time. You got to do wait a minute, Josh, this is what I would have heard. Wait a minute, Josh, you got to do a couple single family homes and then maybe a duplex, before you, do a syndication, but I don't believe that, but that's what I hear, all the time, or I've heard. And I know others hear that too. So what gave you the confidence to jump in and say, okay, I'm going to learn this syndication business and figure it out?
Part of it being a bit naive helped. Partnering for the first one also helped. It allowed us, not that my partner was much more experienced, but we sort of both jumped into the fire together. I don't know. In truth, in hindsight, I don't know that I would do it again. because it really was. I mean, I would and I wouldn't. It obviously got me into it and started track record, and it was a deal that did well. But I mean, in hindsight, very, very risky asset for the first deal. Not necessarily where I would point everyone. And in a lot of ways, I lucked out. I mean, I started investing in multifamily real estate in 2012, where, maybe I was the dumb guy that got lucky by jumping in and timing it right.
Wow. So did you have any partners that had experience in syndication?
Well, my partner did. We didn't, I don't know if, I guess it's still a syndication. We raised money in the form of debt. So we just did all promissory notes, no equity on that one. And we looked for at least 200,000 people in the MSA. Growth, job outlook, diversity of employment to me is a big one. I don't look at all in areas or locations where they may be completely reliant on one industry or the majority of their economy is focused around one industry. And then in truth, I'm just as much focused on the immediate neighborhood as I am the market itself. If it hits sort of positive job growth, large enough population.
What's large enough? What's a large enough population?
At least 200,000 people in the MSA, at least, if not 5. But then beyond that, I'm looking at where is the property located in its neighborhood, in its submarket. To me, that's much as, if not more important than the overall market.
So what are you going to be looking for as far as, where it's located in its specific market? How do we know where in a market we should be looking, or maybe, what are we going to look at and say,
Right.
Let's stay away from that area? So
a lot of it's easy. I jump on Zillow very quickly, look at surrounding home prices. Are you surrounded by $35,000, rundown homes, or are you surrounded by $250,000 homes? School Digger is a website I use, which is a really easy way to look up a school and just see how it ranks. Looking at surrounding retail. So are you surrounded by a, Food Lion or, a nice new Publix? All good identifiers, and it paints you a good picture from afar of the immediate neighborhood without having to jump on a plane.
Nice. So, what else in a market am I going to need to know? So I've never been to this market. I've never lived there. I've never walked the streets. What are some other things or tools maybe you use to learn that market or to dig a little deeper?
So some of it is definitely going to take just time, experience being in it, frankly. But the best insight that I get as a whole is from the different team members, like you said, and call it extended team, like whether it be different brokers from different brokerages. They're ultimately the people that are on the ground every day and able to give good insight. And that really comes from just gradually building those relationships, which is going to take nothing more than time, but spending time with those brokers in person, coffee, beers, getting to know them and letting them sort of paint pictures in terms of growth, opportunity, where they suggest looking, et cetera.
So tell us what JAE Property Group, is focused on right now. What are you all looking for right now? What are you working on?
So I've always been in the not necessarily affordable, but call it the blue collar house, workforce housing type rentals. Typically value add oriented. Something has to be wrong with it that we can come in and improve upon. And in truth, and anyone that doesn't say it is lying. It's a very competitive space to be in right now. Everyone knows that people are going to need a place to live for a long time, and a lot of people just see it as a safe haven relative to the market and other asset classes, which is good and bad. But that's the focus. And what I'm doing more than anything is looking for a real story and some hair on one of these, call it 80 to 150 unit, well located 70s and 80s garden style deals.
So go into a little detail about, that deal that you're looking for. You said it has some hair on it. Obviously, a lot of us deal in the multifamily space, but like I said, maybe somebody just getting started. What are some things that, you're going to see about this property that say, okay, I need to look a little further. There's some things I can do here.
Sure. So a deal I closed this year in Charleston, an 80-unit deal. It was owned by the original developer's family still. Built it in the 70s. It had never traded hands to a non-family member. Rents were below market, dramatically below market. And they really ran it basically sort of back of the napkin type financials. So the challenges or the hair, like I said, was that it's not really financeable. You can't just pick this up and take it to your local bank or to Fannie and Freddie and say, oh, well, the only financials I have are what Bill wrote down on a sheet of paper, and that just isn't going to fly. So that's an example of hair where I'm able to buy at some level of a discount because I can pursue the deal with bridge debt or some sort of unconventional debt. And others might just be completely turned off to it or afraid of it because there's not any real financials that they're buying on. I mean, it was probably bought at a sub 4 cap just because it was that under market.
So go in a little more detail about, you said it's not really financeable. So how do you buy a property like that?
So I shouldn't say not financeable. Nothing's not financeable. It's what you pay for it, for that debt. But when I say not financeable, I meant you're not going to get agency debt of Fannie, Freddie, or even a local or regional community bank is not going to lend on it because it doesn't have in-place cash flow or in-place historicals that they can rely on. If you can't do that, your other options tend to boil down to bridge or hard money. Bridge or hard money, it gets much more competitive in terms of a lower rate as price goes up. So it's nice and attractive even now to still use bridge debt when you're borrowing more than $5 million, but less than that, it could get very expensive. One competitive advantage I had on that last deal was that I was able to leverage a bridge lender that I had previously worked with from my past role that had lent on a larger deal, and they were willing to, just because we had an existing relationship, to lend sub 6% on a bridge deal, 80 units with terrible financials. So that helped the deal quite a bit.
I appreciate you speaking to what your edge was, over the competition. You already had an existing relationship, right? And so, tell us though, for someone who doesn't know what bridge debt is, explain, what that is. You mentioned that, it's costly, right? So tell us what that is and why you would use it if it's so costly.
So bridge debt is typically used for something that needs work and needs to be improved upon. It's shorter term debt, so anywhere from about 12 months to 5 years on the long end. And it's more expensive. It's usually interest only, but you might be paying anywhere from 6 to 10 plus in terms of your rate. Often a bridge lender will lend on the construction costs as well as the purchase price. So that'll allow you to implement your capital improvement plan and then refinance out of that bridge debt. So bridge is really meant to be a bridge to your stabilized product or stabilized debt.
So what is the business plan for that property? So you got the bridge loan, what's next?
So it's been about 7 months. The plan is 18 months in to refinance out of it somewhere before the end of the second year. It's actually, we have 5-year debt in that case. So there's not exactly, we don't have to move super, super quick or unnecessarily quick or pull the trigger on a refinance faster than we might otherwise want to. But we're driving rents and working our business plan and planning to cash out refinance and return some level of principal and put long-term debt on the property and hold it for a while. It's well located. I'm really bullish on the submarket that it's in. And that was a deal that it's just one investor. So it's really long-term hat on, and we're going to go nice and long on that one.
So Josh, what's the number one thing that's contributed to your success?
I think I don't know. I think it's a few things. I think part of it's a combination of willingness to take a leap, sort of like you identified, that willing to take a risk for sure. I think I definitely got a little lucky in that it's a tough environment it could be a tough environment to start in today. Not impossible by any means, but I definitely had tailwinds behind me when I started. And now that there's some scale behind me, it's easier in a lot of ways. But I think a willingness to go bigger, and that'd be my advice generally to anyone, that there's such, believe it or not, there's much less risk in going bigger in a lot of cases than there is starting smaller on so many different levels.
So what's the top reason real estate syndicators fail in this business?
That's a good question. I think it's overly, I think we're going to start overly aggressive rent growth. I think that, especially bridge loans, rates are increasing. A lot of deals right now that are won have to be executed incredibly well to not come together. The nice thing about multifamily is it is generally a safer asset class. So, if you go back to 2009, 10, 11, you didn't have foreclosures like you did on the single family side. You definitely had people not making money. But relative to the rest of the economy, believe it or not, it was still pretty stable. I think a lot of syndicators fail by being lackadaisical with other people's money. Just spending a little bit frivolously and aggressively, and you have to, the minute you take someone's money, whether it be $1 or $1 million, that money should count. It should be way, way more important than to you. It should be like a 10-to-1 ratio, where you losing 10 should be the equivalent of an investor losing $1. And that's how it has to be treated. And I think, especially now in this market, I definitely see other syndicators out there, and it makes me nervous along those lines.
I agree completely. The 10-to-1 ratio. I like that. What's been the hardest part in the syndication process, for you, just going through the business? What's been the hardest thing?
To me, it's been part of it's minimally mental, but maybe it's more than that. Is that with every deal I've done, I find a deal, I put it together, and I have the stressful 30 to 45 days of getting all of my commitments. And especially for someone like me that's raising money often in $50,000, $100,000, $200,000 increments, it could be intimidating and nice and stressful during that time period. And I don't know that that's going to change anytime soon, but it's it's certainly a challenge. And along the challenge lines, I mean, just finding a deal right now is very difficult.
So yeah, raising capital is something everybody, we talk about often, on here. But what have you, maybe give us one or two things before we have to go that you've done to help that problem, or to make it not be such a big deal as far as raising that capital during that short period of time?
Yeah. So start early. If you think you're starting too early, you're not. Communicate, get out a email to your favorite 100 people and just let them know what you're doing. It could be super high level, but introduce it, because you're going to want to introduce it not just for deal one, because deal one, it's always going to be a pretty tight-knit group of people that are just investing in you and not the property. But try to take little steps to establish yourself as the expert. Let them know what you're doing, why you're doing this, send out some market information, share reports, and engage early and often.
How did you How did you convince investors on the very first deal? You know, it was your first deal, you syndicated it, you'd never owned any rental property before. How did you do that?
A big smile. No. So I for that deal, I was raising money with my partner in $10,000 chunks. I did raise money, like I said, as it was a debt investment. So I did personally guarantee it. So I was able to say, well, worst case scenario, I'm standing behind it. So even if I'm a terrible operator and don't know what I'm doing, you're getting this payment, or I'm losing the deal, or worse. Not something I would suggest, especially to a first-time syndicator, and especially to a distressed deal in a rough part of Cincinnati. But you know, you just have to let them be a part of what you're doing. You know, and you're going to give up more than you want to on every deal for a while. If you really do want to be a syndicator, I don't think there's anyone that steps into their first deal and becomes a millionaire because of the great splits they negotiated. But I think being flexible, being creative, and then establishing yourself as the expert is really important.
So Josh, you've been a great guest, and I really appreciate your time. Would you tell the listeners how they can learn more about you and your company?
Sure. So my website's jaepropertygroup.com. My email address and phone number's on there. I definitely encourage you to reach out. And thank you again for having me on. This is great.
Yeah, thank you. And I appreciate the listeners, listening today. And I hope you will go to the Facebook group and join so you can interact with great guests like Josh, and we can learn this business together, connecting with experienced guys like him. Thanks again, Josh, and we will talk to you all tomorrow.
Thank you for listening to the Real Estate Syndication Show, brought to you by Life Bridge Capital. Life Bridge Capital works with investors nationwide to invest in real estate, while also donating 50% of its profits to assist parents who are committing to adoption. Life Bridge Capital, making a difference, one investor and one child at a time. Connect online at www.lifebridgecapital.com for free material and videos to further your success.